Hello, hi students. In today's class, we will try to go through how consolidated financial statement to be prepared under IND AS 110. So I will try to explain these concepts by taking one sum from CA final exam. So this question came during May 2024 final exam. So kindly go through this question in detail. I have also given the summary of the question. So let me go to the summary of the question. So this is 14 mark sum. Okay, so summary of the question is, so you have been given the balance sheet of H Limited, S Limited and A Limited as of 31st March 2024. Okay, and H Limited investment in S Limited is 14,000 shares. It has been given, and these 14,000 shares have been acquired at 5.6 lakh rupees and purchased on 31st October 2023. So these 14,000 shares actually counts for 70% of the investment. Okay, 70% of the investment in S Limited is invested by H Limited, and remaining 30% is the non-controlling interest. Okay, and on 31st October 2023, it has been given that the retained earnings of S Limited was at rupees 5 lakh rupees. And it's also given that goodwill on this acquisition has been impaired. Okay, so these are the information given in the question. And next, H Limited also invested in A Limited. So in A Limited, they have invested 4,000 shares, and this has been invested at a cost of rupees 1 lakh and purchased as on 30th June 2023. And this counts for 40% of the investment in A Limited. So out of 10,000 shares, 4,000 shares is held by H Limited, and remaining 6,000 shares held by other shareholders. Okay, and on 30th June 2023, the retained earnings of A Limited stood at 1.75 lakhs. And the recoverable value exceeds investment value, so which means there is a capital reserve in this case. Okay, and non-controlling interest to be valued on prorated basis. That's also given. So this is the third information. Fourth one is inventory of A Limited includes 60,000 rupees purchased from H Limited, which was acquired at cost plus 20%. So H Limited sold some stock to A Limited at cost plus 20%. So out of the stock sold to A Limited still keep that as the inventory. So they have not further sold to any third party. So the remaining stock as of 31st March 2024 is 60,000 rupees. So let's see how the elimination of profit needs to be done in the consolidation. Okay, then the fifth point is trade payable of H Limited includes 25,000 rupees payable to A Limited, and also it means that the trade receivables of A Limited includes this 25,000 rupees. So when we do the consolidation, let's see any elimination is required from this. And sixth point is the dividend declared by H Limited at 10% and S Limited at 10% and A Limited at 15% for the financial year 23-24. But they are saying it's yet to be accounted for. Okay, then seventh point is a bonus issued by S Limited on 31st March 2024 on 2:1 basis, and this is also not yet accounted for. Okay, so this is the summary of the question. So now let's see how. So here we have been asked to prepare the consolidated financial statement. So prepare the consolidated balance sheet of H Limited as of 31st March 2024. Generally the balance sheet will come with notes to accounts, but here they said no need to prepare the notes to accounts. So only the balance sheet, consolidated balance sheet as of 31st March 2024 should be enough. Okay, so let's see how this can be done. So here I will try to explain you some basic concepts which needs to be taken care when we prepare the consolidated financial statement. So they have given that a dividend has been declared, and this is still not yet accounted. So that has been given in the notes. Okay, so generally when the dividend is declared, this also needs to be approved as part of the annual general meeting. And so this is the financial year 23-24, and generally the financial year 23-24 AGM will happen sometime October 24 or November 2024. But whether the AGM has happened, whether this has been approved by AGM, that is a bit silent in this question. So in that case, we can assume three things: that AGM has not yet happened. So even though dividend have been proposed, since it is still not approved at AGM level, we don't have to do any adjustment. So we can simply ignore the dividend adjustments in the consolidated financial statement. So that could be one scenario. And second, we can assume the AGM has approved, so that the dividend entries can be posted into the consolidated financial statement. And whether the dividend has been paid or not, that is also in this example, it has not been given. So we can also assume the dividend has not been paid or has been paid. So the second assumption is that AGM approved, dividend has to be accrued, but we can assume it is still not paid. And the last option could be the dividend has been approved at AGM level, this has also been paid. So these are the three scenarios could come, and you can mention very clearly in your answer that what assumptions you have taken, and accordingly you can prepare the consolidated financial statement. So any one assumption should be fine. So the examiner will give full mark for this. Okay, so that's one important thing. And second, on the bonus issue, generally the bonus issue will be relevant for the standalone balance sheet. So at the consolidated balance sheet, this will not have any impact, because the income of one entity will be the expense of another entity. So at consolidated level, this will not make any impact. So no need to consider the bonus issue in the consolidated financial statement. However, this would be more relevant when you prepare the standalone balance sheet, but we are not going to discuss that for today's class. So today we are focusing only on the consolidated financial statement. Okay, and third important note is that under IND AS 110, so where you have a subsidiary, so subsidiary means you have a control. Generally, the control comes once the parent company holds more than 50% of the shares. So in those cases, we have to do the consolidation at line by line level. And if the entity holds 100%, you can consolidate all the line items of the balance sheet of the subsidiary into the parent company financials. Right, but if the entity holds more than 50 but less than 100, then still you have to consolidate line by line balance sheet items, and you also need to compute the minority interest, or we also call it as non-controllable interest. For example, in this case, H Limited holds 70% of the shares of the S Limited, so only 70%. So still it is a subsidiary. So in the balance sheet, you have to include all the line items of S Limited when you prepare the consolidated financial statement. And also we need to compute what is the non-controllable interest for the remaining 30%, that needs to be shown separately under equity. Okay, we will go through in detail in this example. Okay, so that's one. And the fourth important point is that in case if the entity holds less than 50% of shares, then it is not called subsidiary company, it's called associated company. So the entity does not have full control over the subsidiary or the associated company, then it is called associated company. Okay, so in this case, line by line consolidation is not required. Instead, you have to refer IND AS 28, where it is called how the investment of the parent company in its associate company under equity method. So you have to follow the equity method. So equity method means any profit or loss of the associated entity to the extent the investor holds, the share of those profit or loss needs to be accounted as part of the investment. So the investment value needs to be adjusted by adding or subtracting the either profit or loss from the associated entity. So in this example, H Limited holds only 40% share of the A Limited. So it's not subsidiary, it's only associated entity. So in this case, line by line consolidation is not required, but the investment of H Limited and A Limited needs to be restated after taking into account the profit or loss of the associated entity, meaning A Limited. Okay, so these are the important considerations you'll have to go through when you prepare this consolidated financial statement. Okay, so now let's get into the specific steps to prepare the consolidated financial statement. So first we will analyze one by one. So first we'll analyze H Limited investment in A Limited. Then we'll analyze H Limited investment in S Limited. So in step 1, let's analyze H Limited investment in A Limited. So it has been given that H Limited's investment in A Limited is 100,000, 1 lakh rupees. Okay, and there is a as I told you under NDS 28, we need to restate this 100,000 under equity method. So equity method means any profit or loss the share to the parent company needs to be adjusted. So in this case, they have given retained earnings of A Limited as of 31st March is 424,000 rupees. And at the time of investment, that is on 30th June, the retained earnings was 1,75,000 rupees, which means the profit made from the date of investment till the end of the year is 2,49,000 rupees. So on this 2,49,000, the share to H Limited, which is at 40%, is coming to 99,600. So 2,49,000 into 40% comes to 99,600. So this 99,600 is a share of profit of A Limited to H Limited. So the H Limited investment of 100,000 needs to be increased by this 99,600. That's a first step. And second, we also need to calculate what is the capital reserve at the time of acquisition. So in the sum, it has been given that the value of investment is lower than the net assets taken over by H Limited. So which means there is a capital reserve. So let's see how this should be computed. So in the example, it's given that the retained earnings balance as on the date of acquisition is 1,75,000 rupees, and 40% of this 175, which means share of the retained earnings to H Limited is 70,000 rupees. And to acquire the 70,000, the consideration paid by H Limited to A Limited is only 60,000. So how the 60,000 comes is the total investment done by H Limited to A Limited is 100,000, and the face value of share is 40,000. So which means only 60,000 rupees in excess being paid by H Limited to A Limited, but the net assets share to H Limited is 70,000. So there is a 10,000 additional gain to H Limited. So that's a capital reserve that needs to be accounted. So this 10,000 also needs to be added to the investment value. Okay, so then as I told you, there is an inventory being sold by H Limited to A Limited, but that remains unsold by A Limited, which means it remains as inventory in the hands of A Limited. So any profit on those inventory, generally as part of consolidation, needs to be eliminated. So the profit is the inventory value is 60,000, and that's sold at cost plus 20%. So which means the margin made is 10,000. So the cost would be 50,000, and margin 20% of 50,000 is 10,000, and total value 50 plus 10 is 60,000. Okay, so this 10,000 needs to be eliminated, but not the entire 10,000. On 10,000, A Limited share is H Limited share at 40%, that is 4,000 rupees. So this needs to be subtracted from the investment. So the total adjustment to investment would be this 99,600 to be added, 10,000 to be added, and 4,000 to be subtracted. So that comes to 1,05,600. So the initial investment is 1 lakh, but the revised investment in the consolidated financial statement we need to show 2,05,600. Okay, so this is important. Then let me go to second step. Here we will analyze the investments in S Limited. Okay, so first step is in S Limited there is other equity, and other equity balance as of March 2024 it has been given as 7,50,000 rupees, and the other equity or the retained earnings as on the acquisition date it has been given as 5 lakh rupees, which means the post acquisition profit is 2 lakh 50, 750 minus 5 lakh is 2 lakh 50,000, and of this 2 lakh 50 H Limited share at 70% is 1 lakh 75,000, and the non-controlling interest share is 30%. So 2 lakh 50 into 30% is 75,000. So this is one part. Let's keep it. Okay. So then it has been given that the goodwill has been impaired. So we'll have to see how much is the goodwill which has been impaired. So let's try to calculate the goodwill here. And yeah, it has been given that H Limited has invested in S Limited for 5,60,000 rupees. Okay. And as on the date of the acquisition, the share capital is 5 lakh rupees, and the retained earnings is 5 lakh rupees. So in total it is 7 lakhs. So the share capital as on the date of acquisition and the retained earnings as on the date of acquisition put together is 7 lakh rupees. So this is, we can take this as the net assets value as on the date of acquisition. Okay, the company's entire S Limited net assets value is 7 lakh rupees. So of 7 lakh rupees, H Limited share is at 70%, so comes to 4,90,000 rupees. Okay, so H Limited actually paid 5,60,000 rupees to acquire the net assets value of 4,90,000. So 5,60,000 minus 4,90,000, that 70,000 is the goodwill. Okay, so this goodwill is supposed to be accounted, but in the example it has been given that this has been impaired. So let's see how the impairment entry needs to be passed. Okay, this is the second one. And third one, we also need to compute the minority interest or non-controllable interest, because this remaining 30% net asset value that needs to be shown separately under equity. Okay, so share of net asset value, so 7 lakh is the total net asset as on the date of acquisition. On that 30% is the NCI interest that comes to 2,10,000. That's one part. And second, the share of the post acquisition profit to NCI. So post acquisition profit is 2,50,000 rupees. On 2,50,000, 30% is 75,000. Okay, so these two together will be the non-controllable interest that needs to be shown separately in the consolidated financial statement. Done. Okay, so then we will go to the next step where we will see what should be the closing consolidated retained earnings in the consolidated balance sheet. So here we have to take only H Limited and S Limited. A Limited is not required because A Limited we are not going to do the line by line consolidation. Okay, so the closing balance as per the respective company, H Limited is 9 lakh rupees and S Limited is 250,000. So first let's go through H Limited. So balance as per balance sheet is 9 lakh rupees, and adjustment from A Limited investment from step 1,05,600. So 1,05,600 is you are going to increase the value of investment in A Limited. So to that extent, the retained earnings of H Limited also needs to be increased. So 1,05,600 should be added to the other equity. Okay, and from here we also need to reduce the goodwill impairment. So from S Limited we have computed goodwill is 70,000. Since this has been impaired, this will have impact to the other equity of H Limited. So we have to reduce 70,000 here. Okay, So these three together will be the closing other equity from H Limited. So 935,000 is the closing other equity from H Limited. And from S Limited, the post acquisition profit is 250,000 rupees, of which 75,000 relating to non-controllable interest that we have to reduce, and remaining 1,75,000 is the share of post acquisition profit of S Limited to H Limited. So that will have to be added to the other equity. So together 935,600 plus 175. So this 11,10,600 will be the closing other equity in the consolidated financial statement. Okay, and this also you need to be remember. So in this example, they said goodwill has been impaired. So that's why we are reducing the 70,000 from the other equity. So if goodwill is not impaired, then we don't have to reduce anything from other equity. Instead, we'll have to show the goodwill in the consolidated balance sheet. Okay, so that's good. And now we'll go to the final step, how the consolidated balance sheet will look like. So you'll have to ensure you follow the standard format where you'll have to put the heading as consolidated balance sheet of H Limited along with its subsidiary S Limited. Okay, and associate A Limited. So the title should be very clear. And this is as of 31st March 2024. And you'll have to follow the schedule 3 format. So where we'll have to show separately non-current assets, current assets, and the equity, non-current liability, current liability. So you'll have to try to follow the standard format. Okay, and here what is the consolidated financial statement would be relevant. Okay, this H Limited and S Limited I have just to put for your reference. But in the exam you don't have to write H Limited, S Limited. You'll have to write only the consolidated statement. Okay, so first non-current asset item is PPE. So PPE from H Limited is 550 and from S Limited is 480,000. So in the consolidated financial statement, you will have to just add these two. So 10,30,000 will be the PPE in the consolidated financial statement. Okay, so then the next line item, goodwill. So goodwill has been impaired, so we are showing zero value here. Okay, and third one is investments in S Limited. So in the consolidated financial statement, we cannot show investment in the subsidiary. So this 560,000 needs to be fully eliminated. So in the consolidated financial statement, you will not have any investments in subsidiaries. Okay, then investments in A Limited. Yes, investments in A Limited will come because it is only the associated entity, not the subsidiary. So investment A Limited, as per the working, you have 1 lakh as the investment value, and this 105,600 needs to be added. So in the consolidated financial statement, you need to show 205,600. Okay, so that adds to the total of non-current assets at 12,35,600. Okay, then inventory, we have to just add the inventory of H Limited and S Limited. It's just totally 867,500, no adjustments. Similarly, cash also you can simply add H Limited and S Limited, and receivables also we can just add. So it's just simple addition of H Limited and S Limited. The total of current assets comes to 17,54,500. So non-current plus current put together, the total asset is 29,90,100. Okay, so then equity. So equity, we have to show only H Limited equity, and S Limited equity should not be added. So in the console, you will have only the H Limited equity. And other equity, as per the working, you can refer, it comes to 11,10,600. So you can see the 11,10,600 from this working. Okay, then non-controllable interest to 85,000. So this also you can refer from this working, non-controllable interest to 85,000. Okay, Then borrowing, you can simply add the H limited and S limited borrowing value. Trade payable also we can simply add. So this will give the total liability 29 lakh 90 100 and total assets also 29 lakh 90 100. So this is how the consolidated balance sheet needs to be prepared. Okay, and so as I told you, this is assumption 1 where we are not taking any adjustments with respect to dividend. Okay, suppose if you wanted to make some adjustment for dividend, that's also 100% perfect. So in this example, we'll see the dividend has been approved at AGM, but it is accrued, not yet paid. So we'll see what are the additional entries needs to be passed in this case. Okay, so first one is we'll take the dividend declared by A Limited. So A Limited total share capital is 1 lakh and they are declaring 15%. So 15,000 is the dividend declared by A Limited. And share of A Limited dividend to H Limited at 40% comes to 6,000 rupees. So we'll have to make an entry for the 6,000 rupees. So the entry will be, you have to receive, H Limited has to receive 6,000 from A Limited. So it's a dividend receivable. 6,000 rupees needs to be debited. And to that extent, the investment value needs to be reduced, 6,000. So in the disclosure, your current assets will be increased and the non-current assets will be decreased. So that's the first entry. And second, we'll see the dividend declared by S Limited. So dividend declared by X Limited is on the capital of 2 lakh, they are declaring 10%. So 20,000 rupees is the total dividend declared by S Limited, of which share to H Limited is 14,000 rupees and share to non-controllable interest is 6,000 rupees. Okay, so for the 14,000 rupees, there is no need for any entry at the consolidation level because it's paid by S Limited and received by H Limited. At consolidation, it will not make any values. So we'll have to make entry only for the non-controllable interest. So for that, the entry is we'll have to debit non-controllable NCI under equity by 6,000 rupees and dividend payable by 6,000 rupees. That's the second entry. And third, let's go through the dividend declared by H Limited. So H Limited equity is 5 lakh rupees and they are declaring 10% dividend. So total dividend declared by them is 50,000 rupees. So for this, the entry is your other equity needs to be debited by 50,000 and dividend payable is credited by 50,000. So these are the additional entries we have to pass to account for the dividend declared but not paid. Okay, so then we'll go through the third model where the dividend has been approved, declared and also paid. Okay, so in that case, these 3 additional entries would come over and above the second assumption. So one, dividend received from A Limited, you'll have to debit the bank account and credit the dividend receivable account by 6,000 rupees. That's the first entry. And second entry for dividend paid to non-controllable interest of S Limited. So you have to debit dividend payable account and credit bank account by 6,000 rupees. And third, dividend paid to shareholders of H Limited, 50,000 rupees. So here also dividend payable debited by 50,000 and bank is credited by 50,000. So these are the 3 additional entries will come under these assumptions. Okay, I think this is clear. So please go through this video in detail, and if you need any more clarifications, please feel free to add to the comment. I'll try to go through and then I'll give feedback.